What's up?
Not much. Good morning, sir.
Good morning. Mr. Holland, good morning.
Morning, Tom.
Okay, so I guess we're waiting for Sherwan and waiting for Neil. So Chief Allswinger's not going to be here today, so we're going to have Chief Reinhardt standing in. Brandy, you see anybody logging in on us?
Not. Nobody is in the waiting room.
Josh will be joining shortly, I think.
I was going to say, where's your cohort lately?
Running late.
Can't do this without Josh, right? We don't want him getting a complex. How about that?
Yeah, he's short enough already.
Man, you need to save that joke when he's on.
No, see.
All right. Sherwan, how are you?
Good, sir. How are you?
All right. Cafe Du Monde.
New Orleans behind you today.
Hey, Dave's always traveling. You never know where he's going to be next.
Just look at speeding tickets, you'll know.
That guy was an asshole.
Hey, things happen, huh, Dave?
Yeah, well, should have stopped me 2 hills sooner when I was doing 107.
His mistake.
His mistake was joining the Mississippi State Highway Patrol.
All right, well, guys, if you don't mind, a couple more minutes. We got to have Josh. Jim, we're going to do your portion first, so you guys don't have to.
Yep, that's fine.
Hang around.
Yeah, he just texted. He's 2 minutes away. He's got computer issues. So.
Okay. Well, we're waiting for Neil too.
We can start any time on our end.
You want to? Brandy, you see Neil coming on?
Not yet, no.
Let me text him. You can't have this without the famous Neil, guys. You logging in today? Just texting, guys.
Morning.
Oh. I just wondering where you were at, Neil.
I'm stuck in the waiting room.
Oh, Brandy.
I'm all right. I'm out.
Okay.
I'm out of waiting room prison.
All right. Let's get everything started. So, Chief Reinhardt has the flag. Everybody rise. Hats off.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, play ball. Good to see you, everybody. Let me get my computer working here. So we're going to do our pension first. And so I guess we still got Josh coming in?
Yeah, but we can go ahead and get started.
Okay. Well, I guess let's go ahead and get started.
All right, Brandy, can I share my screen?
Yes, you can. I did put on multi-screen show.
Okay. Can everybody see my the screen that I got up now?
Got it.
So just a quick review of the agenda. Well, we just did the roll call. Approval of minutes.
Approve.
All right. And then let's go ahead and jump into plan updates. Let's see. So this is where we do our metrics every time, kind of showing the activity of what we do, as well as, hey, Brandy, Josh said he's waiting to be let in. So this is, again, the activity that we do, and then the interaction with a lot of the participants and employees of the district. So we'll just concentrate on that first column, which is the first quarter of this year. The website visits, so those are the visits that participants go to ICMA, and it was pretty even with the fourth quarter of last year, which was right at 642. Not many calls to the service center of ICMA. So most of those folks are actually calling our office and talking to us. So you can see between the amount of emails and phone calls, we were at 205. And then number of appointments with Dan and myself this first quarter was 11. And those are face-to-face or at least virtual. And then participation rate, we have about 42 people actively deferring, which is an average of $3,000 and $3,049 a month. So still pretty active. We'll probably see these numbers jump once people get their first or their second quarter statement coming up here at in the next month, just simply because of the market volatility. Any questions on the metrics?
Looks good.
All right. So let's go ahead and jump right into the investment review. Josh, are you on?
I am. Sorry I'm late. I had some technology issues.
Do you want to drive, or do you have this up, or you want to go?
Yeah, if you let me drive in that way, it can go through the screens. That would be great.
All right, it's yours.
All right, I'm Sheffield. Good morning, everybody. Apologies for being late. Good to be with you. Before I dive in on the report, just a couple things. One, I'm sure we're going to want to talk about the markets. Happy to dive into that a little bit. And also, we have a change in the format of the report. If you looked at it in advance, you might have seen it, so we'll spend a few minutes covering that as well. Just at the high level where we always start, there's two funds on watch, the Vanguard and the Midcap, Hartford Midcap. In both cases, really no concern on our end. The Vanguard is on watch. It had a bad year, so we put it on watch. It's improving. And it's going to, in all likelihood, come off watch this year. Our process means when we put a fund on watch, we keep it there for at least 12 months. It's prudence, it's paying attention, it's due diligence, it's you documenting, having documentation that somebody's actually paying attention, and not just periodically, but on an ongoing basis. And then the Hartford Midcap, and this is getting redundant, it's just a disagreement with Morningstar in terms of where it should be classified. Hartford, and we agree, is a mid-cap core strategy, which means they're going to look for opportunities in growth and value stocks depending on where they see them. Morningstar, understandably, but we're not happy about it, has a firm line. If you have too many growth stocks in your portfolio, you're a growth fund. So literally the trade of one or two positions in a mutual fund portfolio can change its asset categorization by Morningstar. But we pay attention to that. So Morningstar has it as a growth fund. We don't see it that way. Hartford doesn't see it that way. But at the same time, we have to consistently report relative to its Morningstar peer group. It is underperforming relative to the mid-cap space. We're still very comfortable with this strategy and performance. Let me pause there. That was like a 2-minute lightning fast introduction. Any comments or questions before I start going through the report? All right. So, slide all the asset classes represented, equity, fixed income, and the custom model portfolios. Again, jump in at any time. The asset allocation, this is overall in the plan. That the fixed income, actually it's more interesting sometimes when we look at it underneath the hood. let me go here, is overall very strong. We'll talk a little bit more, Jim may want to share in terms of the fixed income allocation, the kind of planning that he does and Dan does do with the near retirement or in retirement employees, able to use that fixed income bucket for short-term income needs, even 2-3 year income needs, and to absorb the volatility in the equity side. So even when the market is volatile for retirees, they're not necessarily selling any of their equity positions. And Jim and Dan can talk about that more. Here's the new stuff. We thought we needed to give a better representation of why and when we put funds on watch, and more importantly, why and when we actually decide to delete a fund. We've always talked about our 4 Ps. People, philosophy, process, and performance. They all go into evaluating an investment vehicle, a mutual fund. Ultimately, just a minute on each, ultimately, there is a person or a group of people who pick the underlying stocks or bonds. How long have they been there? Who are they? Do they work well together? What's their experience, their reputation? Is there a lot of turnover? Or is there a consistent team? Who's actually doing the work? What's their philosophy? What do they say they're trying to do? What are they looking for? Do they believe in high octane growth stocks? Do they believe that in deeply discounted stocks? We're not necessarily judging whether that's a good philosophy or not. We want to understand what their philosophy is, how they approach security selection, and then process what do they actually do based on that. What do they say and what do they do? And do they match? And then performance. So if you have a good team of people who's been there consistently, who can articulate their approach to investing, describe their process, and then actually have consistent performance that's in line with what to understand what's going to downside in the future. So apologies, that was a lot, but I wanted to share conceptually what we're actually doing beyond the performance. And then the next page is actually a scorecard where we're giving you pass, caution, warning on all 4 of those metrics on every fund. And if a fund is failing, failing's the wrong word, if we're getting a warning sign on several of them, that's when we move to watch. And if it stays there for a year or more, we'll consider deleting. So here, let's go down to the Vanguard and the Hartford. If you look at it, it's passing on 3 of the 4, and it's only a caution on performance. Josh, why is it on watch? Well, if we looked at it 18 months ago, those looked a little worse. So as I shared, we're likely going to take those off watch this year. And again, as I've shared many times, watch is the documentation that everybody's paying attention. It's not necessarily a problem. So let me pause. Questions, comments? Is this helpful? Do you like it?
Well, showing process and thought pattern, I mean, there's nothing wrong with that at all, Josh, in my opinion.
Thank you, Tom. That's what we were hoping to do, because otherwise our fear was it was becoming a whole lot of numbers. And the numbers are helpful. I'll go back to numbers in a second, but we can get lost in the weeds, and if we don't have the concepts and the thought process. So diving in to the next level, we'll start looking at where the fund dollars are, and this breaks down the allocation by plan. You can actually, Jim has pointed this out before, if we look at the 457 versus the 401A, the 457 often has a higher fixed allocation. And Jim and Dan can talk about that more. That's also the money that's available before 59.5 without a penalty. So there's reasons why we see that different allocation.
Hey Josh, can you expand your screen? There you go.
There we go. Let me see, I can maybe even make it a little bigger. One day we may be back. All right. And then overall, again, we looked at the allocation. It's solid. If we get into the individual fund performance, and I can go quickly here or slow down, as you can see, everything is solid. it's always interesting when you look at the at an index performing below 50%. Periodically, you actually can have active managers, even in the large cap space, outperform the index. It happens much more frequently in the small and mid. But if we look again at the peer rankings on the 3 and 5 year basis, everything's in the top half. If we go out 10 years, most of them are in the top, half of them are in the top 10% of their funds. So we're seeing consistent performance across the board. Again, you can see the Hartford is where we're seeing the struggle, but again, we point to that. We believe it's the wrong universe. You may ask, then why aren't we showing it relative to a different universe? And the answer is, we think it's important to be consistent in how we report. And if we move things around, if, well, we change the benchmark, it would be like if you changed the standard. You had a standard to promote somebody, but you didn't, but for whatever reason, you either did or didn't want to promote somebody and you changed the standard. Gets you in trouble. And then in the international space, the Euro-Pacific Fund, over the last 5 years, looks like it's underperforming its benchmark, and it is. But we also understand where that underperformance is coming from. Euro-Pacific has a higher than average emerging markets allocation, and emerging markets has underperformed recently. So that's why compared to developed markets. So that's what's happening there. We understand where that underperformance is coming from. It is in a couple of specific years, and we're not overly concerned, which is why it's not on watch at this time. That's really it with the fund menu. I mean, we can look at more of the individual performance if you want. Are there any questions? Do we want to go back to the scorecard in terms of what we're thinking? What would be helpful? Or do we want to talk about the market for 5 minutes? Or 10?
All right, guys, Josh is here. Let's beat him up a little bit.
I have a question. How would you say that the market has performed the last 18 months as opposed to the previous 4 years?
Well, that's an interesting question. So the last 18 months, so let me quickly think about it. I'll pretend it's June 30th. So we're talking about the beginning of 2021. We have seen the only word I'll use is confusing market. I don't think, and I'll go back if it's okay, Dave, even, to earlier in COVID, 18 months, 24 months, or 4 years. We saw a huge drop in the market in March of 20, 30 days, and then an explosion upwards, essentially almost a straight line until the end of 2021. I don't know that anybody would have expected a strong market rally throughout a pandemic that shut down the economy.
Josh, can you just stop there, because he didn't care about the rest of it. Yeah, that was a Trump versus Biden thing.
Yeah.
That was right at Neil.
I missed that.
And Neil knew it. So
fair
he did. Yeah, that was directed straight at Neil.
Fair enough. Wasn't a real
Neil, you owe me a check for $84,000 because that's what I'm down. You know what? I'm happy to write you a check for $84,000. I'm happy. It's not worth anything, but I'm happy to write it for you.
Fair enough.
Sorry, Josh.
No, it's all good.
You're a victim in the internecine war that we have going here.
That's hilarious.
Fair enough.
Because I didn't pick up on it either, and I know how much of a BSer that Dave is. So,
fair enough. For what it's worth, I'll then sum up where I was going to say in 30 seconds. Nobody would have expected the market to go up during a pandemic and then actually crater during a period of ongoing economic growth. Now, what we have now, and something we've been worried about potentially for 10 years, coming out of the crisis in 2008-9, where we started huge money inflows, increasing the money supply in the economy, whether it was through TARP back in 08-09 or through COVID stimulus recently. The concern was always that at some point it would be inflationary. And now that we have a very tight labor market and a lot of pressure on wages, and the growing economy and the war that seems to be disrupting oil supplies, we are now seeing inflationary pressures at a level that we haven't seen in a long, long time. And that's the proximate cause for the market drop.
So Sherwan, did you write all those down?
Yeah, I got it.
You didn't note that President Biden was one of those causes. So just so we know.
President who?
Our RPA is apolitical. I'll stop now because I can see I'm getting roped in. Historically, I'll just share this as a fact. There is no correlation between the party in power and market performance.
Boom.
There is no, in either side, there is no statistical correlation between the party in power and market performance.
Okay, Josh, pick up a mic. You got to drop the mic on that one. Okay, there you go.
Right.
You know, the big thing right now is there's just not a whole lot of good news in the markets, whether it's fixed income in the bonds or equities. And typically when we're going through a big market volatility situation like we're seeing now, the hope is that you have fixed income or bonds that are supporting that downside, that, you know, the more conservative folks aren't getting hit as hard. Well, the bad news is bonds have gotten trampled. I think the Barclays average right now in the U.S. aggregate bonds is down 10%, Josh? Almost 11%.
I have to double check. It was down 5.6 for the first quarter. I haven't checked the bonds yet.
Yeah, it's gone down since, and that's due to interest rates being increased to try to tamp down inflation. Right now, the whole portfolio at Maryland Heights has about 44% in fixed income. Now, the good news there is about 68% of that fixed income is in the SAGIC fund. So it hasn't been. So for the more conservative investors that we work with, we have them a little bit overweight in that fixed account versus bonds, and that's helped out tremendously on these portfolios. But it kind of goes back to the same thing that we always talk about. Virtually everything that we are experiencing isn't things that we haven't seen before in the history of the market, whether it's rising oil prices, international disruptions, whatever it is. These things, they're kind of part of the market, and so kind of keep in mind that the market is mean reverting. So that run up that Josh was talking about from March of 20 to end of last year, that was overperformance. That, there was a little that the market could really support that, and so that those returns were coming down back to that average. So we run through the same scenario where now people are in fear mode, selling, which is always the best time to try to put more money into it or rebalance your portfolio, and then we'll see it hit a bottom and it'll come back up. So it's kind of the same thing it always does.
That's a great point. It's hard to believe given how fast it's come down in the last month, but right now, if we go back 12 months, back to June of 21, the market's essentially flat. So we've given up this year what we made in the second half of last year, which is why it's so important to stay invested, like Jim was saying. If you were in for 5 years, you're still way ahead.
So guys,
You're going to be in a lot longer than 5 years from now, so you find more shares.
Right. So kind of this wild, wild west stuff, I think, is, well, you guys are the experts. So fundamental investing now is really being, I guess, the most important part. This wild, wild west stuff with all this electronic NFTs or whatever. You see Bitcoin now. Those things are down 50% or even more. So thoughts on that stuff? There's a lot of money in that cryptocurrency.
So
I got it, Neil. So if you were in it for 5 years, you're going to be up because of those first 4 years.
there we go. Now that we've got the timing worked out, thank you. To Tom's question.
Randy, could you please mute Sherwan?
Cryptocurrency, NTFs, non-fungible tokens, this is all this, like Tom said, digital blockchain, which has the potential to, transform the financial system, similar to the way that the internet transformed commerce. We didn't think when Amazon came out as here's a better place to buy your books, that we may stop going to Sears, or that Sears would go out of business potentially. So that's the potential, but that's still in the future. The complicated part for individual investors is that there's a lot of attention to crypto. It's very sexy, it's very appealing, it's very speculative and very risky. And now I'm speaking to you as a board. It is a non-regulated security. There is no guidance or guidelines from the SEC on a regulation of cryptocurrency. So as fiduciaries, to consider it in a plan where you are the prudent stewards of other people's money is absolutely not recommended. Which is not saying it's a bad investment. What it's saying is the risks are unknown and unknowable at this moment, and that as a fiduciary, without regulatory guidance, protection from the regulators, what will give you safe harbor, what oversight, what reporting is necessary for you to be able to do your due diligence, or us as your advisor to be able to do due diligence, simply doesn't exist. Our firm policy is not to give advice on cryptocurrency today because it's exactly what you said, Tom. It is a wild, wild west still. That will change over time. Nice background, Dave. That will change over time, and as it does, we're on it, we're paying attention to it, and when there are guidance and guidelines that allow you to prudently look at it, as a committee, as an employer, as a plan sponsor, we'll be there with you. But that's not today.
So bottom line is nobody's going to get involved with cryptocurrency, correct?
Not in this plan today as your investment advisor.
Guys, do we hear him?
Loud and clear.
And stay out of reach.
Yeah.
REITs are a component of the S&P 500, and the non-correlating or the risk mitigation value of REITs is included in our construction of the custom models.
Okay.
A lot of your mutual funds, large caps already have them in their portfolio to a certain degree. All right. Any questions, comments, constructive comments?
Different backgrounds?
Emphasis there, Jim, on constructive.
Now we are starting to see a pickup in calls just across the board, not so much from the participants at Maryland Heights. The pickup of phone calls of concern hasn't turned into panic yet. I had my first panic call yesterday and was able to walk a non-Maryland Heights person off the ledge as far as wanting to move everything to the fixed account. But it's you can feel the momentum of the worry and the fear, and at some point again it will subside and it'll find a bottom and it'll go back up. And the risk is getting out and then the market rebounding quickly. If there's if the Russia-Ukraine issue is resolved, you'll see the market probably shoot up, dramatically in a week's time. And so it's one of those things where you just can't predict when that stuff is going to happen.
Makes
Jim,
sense.
I do have a question. Is it not true that once you pull out of equities, you cannot get back in equities 30 days later? And
in this situation, I don't think that ICMA has a equity watch or a restriction on that. They do have restrictions of frequent trading, so they do restrict how much you can go in and out of a couple of investments at short intervals. But participant actually could put monies into the 100% into the SAGIC and then move it out 20 days later back into the market.
Thank you.
But we work very hard to keep people from doing that because you know, at the end of the day, it is goes back to we build these portfolios based off your time horizon and try to pay attention to the risk tolerance of how much of the downturn you can take without, you know, pulling the ripcord. We spend a lot of time on that, and then we try to keep people to those strategies because at the end of the day, that's what works.
And at the end of the day, downside volatility is an opportunity to accumulate. I mean, most of you are still buyers. You're not sellers at this point. So when the prices are going down, that's your opportunity.
Absolutely.
All right, well, guys, any comments from the board to our three experts?
I don't think I have anything. Very well explained.
All right, well,
Okay. We need to pick another future date.
yes. You guys
Josh,
pick.
thank you for your patience.
Of course. Should we look at August?
We're on your schedule, guys.
Tuesday the 16th?
Yeah, good for everybody?
Yeah,
Randy?
I'm good.
Perfect.
That works for me.
Okay.